This will be recorded. Depending on how we structure things and how it goes, we will make it public for you guys to watch to understand what we say, because we'll be talking about a lot of new stuff that you guys probably don't know. Our first session we had last Friday, most of the people are coming back for a second, I guess, helping to understand what we talked about a little bit more, because we're in a little different space than you guys are at. If you do want to send something privately to Nathan or myself, feel free to do that. We'll be monitoring the chat on that field. So we'll be doing all that stuff. So for right now, we're going to keep videos off for right now, just because we're going to be sharing screens and whatnot. So don't worry about your video for right now. We'll be definitely opening up. We're going to feel free to put chats, stuff like that in the bottom. But we're going to be sharing screens and everything else. So cool. We have a minute. Feel free in the chat, just to kind of introduce yourself. Please tell us where you're from. How many creative notes have you done? Have you been doing it for a while? Have you not? So how many notes have you originated, and what state are you from? So if you could put that in the chat, that'd be awesome. Just so we can get an idea where you guys are at, and your experience level. Cool. Awesome, awesome, awesome. So as people start tuning in here, we're going to do a quick introduction of myself and Nathan, and what we do, how long we've been doing it. Newbie, okay. Awesome, Jason. My kids are away and hopefully hiding. We may be interrupted. Awesome, Jay. That's awesome to see. You'll be learning a lot too. So this is for those who are beginners as well as experienced. You're probably going to learn quite a bit here as we go through here. We'll definitely look for Q&A in a little bit, but we're going to cover a lot of stuff before we jump in here. So we're going to give it to 702 for people to jump in here. If you have a particular question, again, put in the chat for me and Nathan. You can direct it to one of us. We will be talking about some higher level stuff. That's awesome. Creating notes for others, that's awesome. You hear that, Ebony?
Good.
Georgia, that's awesome. So those who are experienced and those who are rookies, this will be something you're gonna take lots of notes of, and most likely be pretty surprised on what we're gonna say. Last call we had Friday, we had a lot of people who had experience, and what we found was what they learned may not be fully true on both sides. So for those who missed it, we'll repeat it. Put what state you're from and how many seller finance or wrap note creations you've done.
Whatever your history is, any kind of seller finance deals you've done, anything like that, creative stuff. Yep. Like awesome. To know where we're coming from here.
Yeah, we got to talk student level there, right? So I'm Brian. I see you're in Tennessee, Mountain City. Woo! I like it. North Carolina, Tennessee. Yes, that's awesome. We like those states are both great states for us.
Yeah.
So, and I know a lot of you guys follow either Mark Monroe or Nick Ligamaro or Brian Carlson. All great people. We work with them all. We're just not them. We're on the other side of them. We want to call it. We're not competing against them at all. We're actually partnering with them.
Yeah, we work with them to help train people how to do this so we can buy your notes.
Yes. So 702, as I promised, I see some more people could be registering and logging in shortly, which is great. I would encourage you, New Jersey, look at that. I hope you're not doing, Damon, I hope you're not doing several finding notes in New Jersey. I'm in New Jersey myself, and we avoid that like the plague. But Newman, Georgia, that's okay. We're going to keep, okay. In PA, I'm not a big fan of either PA, but
no,
I'm
not really, but that's okay.
Central, yeah, the whole Northeast is not something we like doing, even though I live in the dead middle of the state of New Jersey. So awesome, guys. I appreciate you comment in the chat. 15-0 Tennessee. We like Tennessee. We enjoy that. Oh, California.
Second for 275. Wow, that's one heck of a second.
Yeah. Woo-wee. I'm presuming that may be a wrap second, but we'll get into that in a little while. That may be a wrap.
Yeah.
Sounds like a wrap. So it's
Yeah.
interesting how the seller finance world calls wrap seconds. I'm not really sure we classify them as seconds, but it's interesting. So state and how many deals have you done?
Very good. Very good. So we've got some experience here, at least. That's good. And if
Yep.
you're brand new, that's fine too.
Yeah. So for those who are brand new, this is gonna be a lot of information. Those who experience, this is also gonna be a lot of information. So awesome. I see Eric in here. Great. One wrap in New Mexico, second wrap. All right. Look at that. A whole second behind 430, 473. That's awesome.
Mm-hmm.
Awesome. Awesome. All right. So we have a bunch of people could be joining in tonight. We're expecting a little over 50 to join in here. Plus, I see about 6 more just registered. So let's start off. I'm Dave Putz from JKP Holdings. Nathan Turner from Ernest Investing.
Mm-hmm.
So both of us are note buyers by trade. We're not in the same company. And what we've done for well over a decade individually have been buying notes. So what we're focusing on tonight is I'm presuming that most of you guys have created a note and you have note money trapped in that note and you would like to buy another property or cash out something, and you would like to see how to create this note so that you get the most dollars. And you may be saying to yourself, well, that means you're pre-scamming me. No, we're not trying to scam you at all. We'll pay based on parameters that your notes created, that we'll pay a higher dollar amount because of what it is. I hope they make sense, right? If you structure a rental property to a higher rent amount, it can be sold for more money sometimes, depending on the deal, right? So we want to structure this note that you're creating for every asset so you understand how to structure it so it can be sold on the secondary market. So Nathan, can you share a little about your background, about what you do and what we've been doing for years?
Yeah, for sure. So Nathan Turner, I see Nilay's from Toronto. Fantastic. I'm Canadian. I live just outside of Calgary, Alberta. That much closer to the Rockies. It's fantastic. Love it. And let's see, sorry, I have a little bit of a cough today, so I'll try to keep it under wraps. I got started in 2008. I was creating notes like many of you guys are doing now. I was creating notes mostly in Columbus, Ohio, and that was kind of my beginning, my introduction to notes as a business. And as I learned more and as I met more people, I've kind of shifted and learned and honed whatever I'm doing. These days, just we'll fast forward a little bit. I've done non-performing notes for years and years. These days, I'm buying primarily performing first lien notes all over the US. I don't do anything in Canada. And I started a fund so that people that want to invest passively can do that with me as well.
Cool. And same with Nathan, for about first 10 years of buying notes, it was all non-performing first liens. We've now switched over buying performing just because the market way it is. Primarily bought bank originated debt for all these years, right? And we've now marched over to the seller finance world for numerous reasons. But what we found when we switched over was that these notes weren't created. Hey, Joe, weren't created an idea of a note buyer buying it, and they thought in a borrower's perspective, and are doing it illegal functionalities that these notes are created in a way that cannot ever be foreclosed on, which is one of your exit strategies. And I know that you're probably saying, well, they haven't never stopped paying. Well, the problem is never, always is never, right?
And we never want to foreclose on anybody. I don't ever want to kick somebody out of their house. I get it 100%. But you have to know they will go non-performing at some point. Some of them will. So knowing how to structure it now so that in future you're covered and you can get through it a whole lot easier.
Yeah. So we're going to talk about tonight how to structure notes that if you ever had to foreclose, it is a foreclosable file.
Yeah.
And what the do's and don'ts there are. We're going to talk about how you can structure. So if you ever want to sell part or whole, or how can you structure the note so that is a possibility. Now, we don't expect you to sell every note you own, but if you do, we want you to think of us, but we also want to show you how to do it, that any note buyer out there will buy a note for more money if it's created in an idea of a note buyer mentality.
Yeah.
What we won't talk about tonight are things such as how to find borrowers. Not talking about it, right? How to find wrap notes, how to do this. We're not talking about that side of the space here. We're talking about if you need to ever sell it or foreclose, what does that file have to look like for both to be possible?
Yeah. Hey, one more thing I need to mention. I keep forgetting to say this out loud, but I'm also the owner and host of the Diversified Mortgage Expo.
Yes.
Big focus on, we want note creators to be there. That's a big push. We want you guys to come out to this conference because there are note buyers there. So there are people there that will buy your notes. If it's not me or Dave for some reason, there are plenty of note buyers there that are hungry for deals. So again, we want to make sure that you know how to create these properly so that they're very attractive to anybody that you're going to sell them to.
Absolutely. Dean, if you're interested in buying notes, it may not be the best conversation, but I definitely would turn in Diversified Mortgage Expo. He'll put in the chat, I'm sure, DME, right? That happens in May. For those who've probably seen us, we run a bi-weekly webinar podcast on note buying and note in general. We've had everyone on there from note originators like Brian Carlson and Nicola Gamaro, Mark Monroe, Dan Diaz, all the big players out there have been on our show. And we do it every other week, webinar podcast, and then DME will be at the end of May. That's a great conference for those who are in the seller finance world. If you're looking for capital to buy your notes, they're all there. But we'd hope you come to us first. So tonight's show or video is all about how you can create these things legally and make it a foreclosable file. But on top of it, how do we make it so you can sell and make it valuable for the highest dollar? So we'd like you to put in, if you could, in the chat, if you're just jumping in here, please put in there what state you're in, the idea where you're at, as well as how many owner finance, seller finance notes you have created. That'll help us understand the crowd a little bit more. So if you created one note or if you create thousands of notes, we've talked to a lot of people, and this is the problem. A lot of note originators have no clue you can sell a note. So first off, you can. It's completely legal.
And we're very happy to buy them. This is our whole thing. So like I say, I was creating notes way back when, 2009, 2010, 2011. And I'm not knocking creating notes at all. It's a fantastic model. I switched out partially because of some of the rules that came in that we're going to talk about tonight. Some of the rules that actually came in back then. And that's what really was a part of me converting to just buying pre-existing notes. Today, I'm all about buying pre-existing notes. I can and will create notes from time to time if I end up taking back a property. But by and large, I'm looking for notes that somebody else has created that I can buy.
Absolutely. Well, we want to first, we have a nice little outline and we can share with you guys eventually if you choose to. We want to extract out that extra equity you have in a property. So if you've done a wrap note or you've created a note by doing certain situations and you have equity or whatever, or you create a first and second lien, maybe you say, why would I create first and second lien? That's what we'll talk about tonight. So if you create this note and you see, I'd like to get some of that money and go do something else with it. And you can probably, if you got 100 grand, you could buy 3 or 4 properties with that and do more notes and make 50% of the money I give you. We want to do that. And we can give you unlimited capital to do that, right? We just want to make sure you structure it right.
Brian's got a great question in there. We're going to circle back to that in a little bit. That's a great question. And yes, we'll go through how to make that as attractive as possible.
I love it, Brian.
Larger numbers. And so just be aware that that's not every note buyer. However, there's a note buyer for every size, shape of loan. So we'll get into that.
Absolutely. So let's talk about the first thing first, right? Those people who are doing these wrap loans and seller finance notes and stuff like that, there's one big thing you guys have to all be aware of, this thing called Dodd-Frank, right? The idea that if that loan is in a position where the borrower also occupies the property, by law, you must make sure that they underwritten and they have an RMLO in place. You're allowed up to 3 a year, right, on the RMLO part. But if you're underwriting, you need to underwrite every borrower that is occupying the property and they have ability to repay, right? You think it's under 43% debt to income. But you mean to make sure that you have someone like a Call the Underwriter or a Mark Ross or any other one else out there who can do underwriting for you, right? I'm sure you guys probably use that. If you haven't, we can share information about that. That's a crucial thing. If it's a landlord, there is no underwriting needed. It's a deal between you and that person. We recommend doing it to make sure they have the ability to repay, but it's not required, especially the RMLL part. So when you do this,
we won't go too much into all the laws with Dodd-Frank. We're just going to say that it's there. If you have specific questions, you can talk with somebody, a mortgage loan originator. They can fill you in on all the details, all the juicy details. But suffice it to say, for now, it's there, and we need to play by the rules, like them or not. That's what it is. So we're going to do what we can to follow along.
So we're going to talk about that for a minute, right? So when you create these notes, and what we're going to talk about tonight too is what makes or breaks a note for a note buyer, but also what changes the return we need. So if you have a flat return, let me give you another myth that's out there. Note buyers, I love to hear in the chat too. How many people heard that note buyers buy on a percentage of UPB? I'm sure I'm going to see the chat fly by with this, right? It is the biggest myth going. I won't say that all note buyers don't, but experienced ones don't, because beginners just don't realize. No note buyer buys strictly on a percentage of UPB, and there's numerous reasons why, right? It doesn't calculate it. It's not the way notes are built. So if you've heard that, I'd love to hear in the chat on what you've heard about that. Buying a percentage UPB does not function out. It just, the math doesn't work. So we're going to say we're basing it by yield or IRR, which is different from ROI or cash and cash, right? Thank you, Dean. Unpaid principal balance. So if you have a balance of 475 or 80,000, right? That's where it's at. So that UPB is, the original loan is 100,000. It's now paid down a little bit. You're down to 87,936 and 52 cents. That's your unpaid principal balance, right? Which is different from legal balance. And legal balance is regarding the fact of what is this debt plus any arrears or extra charges, taxes, or any kind of other items we can add to the bill the borrower has to reimburse us for.
Late fees, legal fees, whatever, anything extra besides their regular monthly payment.
I've always been in a discount yield in conversations I've had. Absolutely, right? We're based on yield. So I have a great chart for you guys. I'll put it in the chat here. You can take a look at it as we go through. If you guys are curious about it. This chart kind of shows you a discount, and it's a little confusing. I know my buddy Joe's on here going, Dave, don't talk about this yet. It's a little overwhelming for most people, but keep that in the background for yourself. Understand the fact that if you have an 8% note and we're looking for a 12, the discounts could be there, right? One factor going towards it. So we're going to go to the next topic. Actually, I'll share my screen so you guys can see what we're talking off of. And if you guys need this, let me know, and we'll go from here. So we have this whole situation here, and we have a great outline. So we just talked about the owner occupant that is required. I'm telling you now, if it's a non-owner occupant, we have different situations here. So if you don't underwrite, or if you haven't, we're going to have to get it underwritten, which means we have to work with the borrower to get the whole deal redone, which will cost us time and money, right? Not that we can, but we're going to charge more money because it's going to be more work for us to do.
Most of the time it's fixable. Most of the time we can go back in there and do the proper underwriting and add that to the file. But it's something that is required. So we're going to have to do that if you haven't already done it.
Yep. We take this out. The next topic we talk about is we're going to talk about security types, right? So security type is, what is the loan based on when you're creating it, the lien to the property in the county records? Most of you guys have probably done contract or deed or land contracts or some kind of fashion where the deed is held from the borrower until they make a payment, similar to a car deal. There's the other side of it where they get the deed up front, which is a mortgage or deed of trust. In that kind of facet, most note buyers, most note originators go, well, dude, the contract for deed is so much easier. Why would I not do it? The problem is that sometimes note buyers, depending on the note buyer, we're going to say this over and over again, depending on the note buyer, they may discount it more because of the fact that it's a land contract. Some states don't like it. Texas, you can't do them, right? And it is what it is. What we can do is what we can do, right?
And this is so the contracts we deed in Ohio, they're called land contracts. That's what I was doing. That's when I was first starting out, we were selling houses on land contract over and over and over again. And it was great. Part of the reason that a note buyer is going to consider that less valuable, just that instrument, is because the borrowers tend to be lower quality on a land contract. And that's not a dig, that's not a reflection on anybody, but that, generally speaking, those tend to be a lower quality borrower. What I found when I was doing that is those borrowers that we're doing the land contracts with, they tended to be somebody that had just been a renter or had been a renter their whole life. And this is the first time that they were introduced to the idea of owning their home. So I still had to deal with people calling saying this was broken or that was broken and come and fix this or that. And I'd have to say, well, no, you own the house now, or you're in training to own the home, or whatever the line was. But that those repairs and things were their responsibility and not mine. And so a little bit more touch needed with those borrowers, a little bit more work. So generally speaking, they're considered less valuable as an instrument, security instrument.
Yeah, absolutely. So I'll put this in there just to see where people are at. If you could just quickly pick your choice there. So on the flip side here, when we talk about this stuff, there's a little bit of a discount that goes on here, right? So when it comes for deed land contract, you can quickly evict people from there. However, if it's in certain states, there's certain things where 20% pay down 5 years. It can act like a mortgage in certain states. So just be careful of that, right? Yeah. On the
like
flip side,
Texas. Yeah.
Yes. In Texas, you can't do them at all.
No.
So lease options, a very similar thing to land contract, but it's a little different structure. These things are a little bit more hairy because sometimes judges don't like them and they may start getting more and more banned. So understand that's what's going on there, right? So again, I see,
same kind of thing. Like I have bought lease option contracts in the past. And what I've done with them is immediately convert them to something else, whether that was a contract for deed or into a mortgage. I've done both.
Again, it makes it more valuable.
And more valuable for me to resell later.
Yeah. So we will be getting to a spreadsheet here. So hang with us. We're going to be getting to that. We want to go through a bunch of stuff here. So if you are curious, again, feel free to put in the chat. If you're new, what state you're in and how many deals you've done. We have a little poll here going. So the next topic we're talking about is a big one. So if you're not familiar with a financial calculator or any of this stuff, this is when this comes into play. So when everyone hears about this whole thing about percentage of UPB, this is the part of the note buying space that throws the percentage of the balance of the note out the window, right? As one gentleman said, Brian said, it's all about the yield. And the yield is calculated by multiple factors that come together, okay? So our note numbers, this is a key thing. This will change your price. I'll put this in nice red font here for you, right? This will change your price. When we talk about this stuff, we talk about the fact that the balance alone, the legal balance is a collectible too. But when we talk about the principal value or present value or PV in our calculator, that's the original balance or the current principal balance in the financial calculator. That's the original balance you created and now what's due. We're going to talk a little bit later about how you should be servicing these things. If you're working with a third-party servicer or software, you got to make sure that they're doing this. If you aren't working with a servicer and you don't know right now how every loan, what the balance is, you have an issue because that borrower wants to pay off tomorrow. You need to provide it to them. The next one is payment. This is your monthly payment. This is key because we run into a lot of people who are originating debts and they don't understand this. The monthly payment to note buyers, not to the borrower, but to note buyers, is only P&I, principal and interest. There is no taxes and insurance in this at all. I understand that your payment on your borrower is this, and inside your note should be principal interest and then tax insurance separately. You should never have them together. If you do have them together, there will be a problem, right? Because
That
the
tax
tax insurance
insurance.
will fluctuate.
Right. And that tax, it fluctuates, and that creates a huge problem already. And then number two is taxes and insurance. Those are two things. That's the borrower's money. It's not money that we get to take home. That's the borrower's money that's put in escrow in order to pay off annual taxes or annual insurance costs. So it's not our money. We had a discussion about this. I don't remember if it was on our last call that we did, where for example, so I had a borrower once where they were overpaying their tax and insurance portion. So they had like a $2,000 overage. Me as the lender, I cannot instruct the servicer to apply that to principal and interest, even though at that point they were a couple of months behind, and that would have more than covered their arrears. That's not my decision to make. It's the borrower's money. They have to be the ones to direct the servicer to say, yes, apply it to principal and interest, or write me a check and I'll do it separately. But whatever it is, that's their decision. You don't have any say over that.
Absolutely. That's awesome, right? So when we ask for what the monthly payment to note buyers, we're talking about the principal interest only payment. That number in the life of the amortization schedule does not change ever, ever, right? So the next one we talk about is term. This is the number of months either left or the number of months in the beginning of the note. This will definitely change your note price. So put an asterisk, a star, whatever you want to put against. This is crucial because of the fact that the term will fluctuate the price what I give you. I want you to think about a lottery winning, right? If you're going to get paid over 1 year or paid over 25 years, which one would you rather get paid by? The 1 year. Shorter term, the higher I can pay for the note. So exact same balance alone, $100,000 note with a 1 year term, right? With everything else being the same, I'll pay more than one that's written for 25 years.
Now, the challenge with that is the borrower probably can't make that monthly payment if it's only spread out over a year. Because that monthly payment's going to be huge. So it's going to be spread out over some number of years. 10 is very short. 20 is on the short side. 30 is kind of standard, just so you know. My ideal is 25 years. Because I have the fund, it bumps up the monthly payment just a little bit, and then it still allows me to have enough principal balance left at the end of my fund where I can then sell off that note. So
again, if you have questions, feel free in the chat or send to Nathan and myself directly. We hold bi-weekly webinars. This is something we do for everyone. And you can definitely tune into our next one, which is in 2 weeks anyway.
Yeah.
So balloon typically is not used in our space, and you guys do use it in your space. I think it's 7 years out, but you can use it. That will also change a little bit. The next.
Now, hold on 1 second before we move on from that. Balloon. So one thing, again, going back to Dodd-Frank, if you are selling the property to an owner occupant, somebody who's going to be living in the house, your balloons are not allowed as per Dodd-Frank. If you're making that loan to a corporation, a company, some kind of an entity, yes, go ahead and include a balloon in there if you want. Personally, I actually prefer loans without a balloon. They're easier to manage. Part of it for me is if it's a balloon due in 3 years or something, the likelihood that they're actually going to pay that loan off in 3 years is not very high. So it's just easier for everybody if it's just not there at all.
Individual investor. So landlord, same idea. As long as the borrower is not the occupant.
If it's some kind of an entity, that's ideal.
Yep. Or an investor, right? Yeah. If it's Nathan Turner, the landlord, that's fine. Sure. He's typically an investor, right? So the big next one is interest rates. This is a big one. This is yield. This is everything key, right? The interest rate is what I make over the principal, right? So if you write $100,000 note and they only charge principal, you make $0. Mm-hmm. The interest is what you're going to make. And amortize over 360 months or 30 years, your average annual will be the interest rate, your yield. If you have a lower interest rate on that originated note, you will get a higher discount from us. Okay, let me say it again. If your interest rate is a 5% interest rate and you're looking for us to pay par, or which means par is that you're looking for me to pay you the balance of the debt, it ain't gonna happen. Right? Most likely we're never gonna pay par, because if we have pay off tomorrow, it doesn't work. But if you create a note at, let's go crazy, a 20% interest rate note, you're gonna get close to par. I'm gonna guarantee it.
Yeah.
You create a 1% note, I guarantee you will never hit par, ever. Okay?
Yeah.
Understand you are not higher than the bank. The bank is the golden parachute. If the borrowers can qualify, they go to the bank. If the borrowers can't qualify for a bank or don't want to, they come to you. So when I hear people say, well, I create a 5% note, my first question is why? They came to you because they couldn't.
Yeah. Don't try to compete. You've got a special product. You've got a special thing that you're offering that's worth more money. So charge more, and more meaning like 9, 10, 11%. Like, yes, those are the numbers we're looking for.
Right. So if you created an 8% note on a 360-month payment, $100,000 balance loan, and I'm looking for 12%, I'm going to pay you $71,340 approximately. We're not going to say it's exact, but that's an idea. If you created a 10% note and I'm looking for 12%, 85% of the balance of note, I'm going to probably give you an offer around that number. But performing wise, not non-performing, which we'll get into. Does anyone have a question about this chart? Because this is overwhelming, and I'll share a link to this chart, which I think I already did. This chart will tell you approximately what the discount is going to expect to be on a performing situation, not a non-performing, but on a performing idea. But this tells you if you created, I have a huge chart down here in the bottom. I know Joe's probably crying over there. If you create a 5% note, which I just did see on social media today, and I'm looking for a 12%, I'm going to discount it down to $52,000 out of 100. Right? I'm sure none of you guys want to create a $100,000 note and you want us to bid you 52 grand. But I can't. But if you made this a 10%, I'm now up to 85. Huge.
I got a tape of 11 notes this morning, all 11%. Now we're talking. I can give you about 92% of that.
Approximately, right?
That's approximately.
Damon had a question about sellers want balloons. Do a seller finance note, want balloons. We can still wrap that. Sell a note or sell partials. Clear underlying time of balloon is right. I'm not sure exactly what he means by that, but I'll reread it again, Damon, in a minute and see if I can get a better understanding. I know, or we'll open up and chat in a little while. So hold that note, that question. Maybe we'll get a better understanding of it. So,
so this is, for me, this is interest rate is like one of the number one things I look at. It's probably, I look at the state, I'll look at the interest rate, and I'll look at the unpaid balance. Those are like the top three things I'm going to look at, right, to begin with, and then term as well. But it's like one of the most important things. So do not write your loans at 5%. You won't get very much money for them. Write them at 9, 10, 11%. You'll do much better.
So one of the things we're going to talk about is that one of our keys is the fact that we're going to top end our investment to value will never get above 75% of the property. And you say, whoa, Dave, I just create a one lien at 100% of the balance of 100,000. You mean you will not give me over 75%? That's correct.
Correct.
And you say, whoa, but the yield is a 14. That's great. The problem we have is unless you can guarantee me payments for the remainder of the term, I have to count the fact that it may default in the future. SMED. We don't know. And there's some math behind it. We came up with around 75%. So 75% investment to value. Sorry, I didn't say it before. Investment to value. Right.
So meaning if it's $100,000 value, I'll pay you $75,000 max. And that part of the reason is if they default, I'm going to have to do a foreclosure. Just worst case scenario, I'll have to do a foreclosure, and then I'm going to take back that property. What if in the meantime, the value of the property dropped? Or what if in the meantime, they didn't take care of the property, or worse, they even vandalized it? I need that cushion there to make sure that when I get that property back, it's at least worth the 75,000 that I paid for it, at
Yep.
least. So it's a way to protect ourselves as note investors. We want to make sure that there's at least some equity in there.
So I see, Brian, what's the ideal rate term ratio for first lien possession for resale purposes? Well, I'm gonna tell you, the higher the interest rate and the lower term, the best, right? If you want us to give you as close to 100% of the balance, make that damn thing a 15% 1-year term, right? The problem is the borrower may not be able to qualify for that. So you have to balance it out. We're going to show you a calculator in a few minutes what that looks like, but not every note's gonna be exactly the same, right? Yes, current appraisal, it's a
Right now.
ballpark, right?
But current appraisal meaning not ARV. I'm not looking at what the value is after they do some repairs to
Yep.
it, because I don't know if they're going to actually do those repairs or do a good job or anything. So it's today's value as is, warts and all, broken windows, whatever it is, peeling paint, current value, not an after repair value. That's a great question.
Good. All right. So, and our target, again, this is an average kind of number to throw it out there. Some note buyers are going to be different. We're going to set the yield price at 14. So that's a discount off that chart, right? Get an idea of what that looks like. Some will be at 12, some will be at 13. Depends what kind of capital they have at the time. They may have cheaper capital at the moment where they use some of the more expensive capital and they have some free capital. They can get a better deal. Depends on the situation, depends on the time. You asked me a year ago, 2 years ago, that number changes. And we'll get to this in a few minutes. Another key one also we'll get to is the fact that the borrower pays servicing fees, which we'll get to. Okay. Let me scroll. Where were we at here? We are down here. So when we talked about the fact that ITV, the investment to value being 75% or so. The reason we say that is because that one of the things you say is, well, how can I do it 100% finance note, one note? Then don't make it at 100%. Make it an 80, make it a 70. You make it a 70, if it's true, that 70% is below a 75. So technically, now I'm based on yield only because that investment of value is there. That's a $70,000 loan. Well, if I was gonna be able to pay 75, it's great. Now it plays on the yield factor.
Even with
sense,
the
guys?
80/20. Yeah, even with the 80/20. If you've
Yep.
taken some kind of a down payment, ideally, and we'll talk about this in a minute, but ideally
Yeah.
10% or more, if you can get at least 10% down, again, we'll go back to the $100,000 value question. Sold for 100,000, you got a $10,000 down payment, and then you create an 80/20.
Yeah.
You're way under that 75%. So
Perfect.
that's no problem.
Yeah. So sometimes you want to create the 80/20, and guess what you can do with the 20? Make it a little higher interest rate, and you keep it. Now you get all your money out, hopefully, and you guys have a second lien at 20% of it for 60 payments for 30 years, 25 years, whatever it is.
Yeah.
So what is ideal for this? Well, the lower the number, the better, right? For you guys. We love to get in a position where we're really low LTV, ITV kind of stuff. But we understand it's not always a possibility. Again, you have to work with your borrowers. Some people say, well, Dave, I can't get a borrower at that price. That's fine. You don't need to sell the note all the time. We're not saying you should or have to. We're saying if you want to, this is the way to do it. Okay?
Yeah. Yeah.
Next, we're going to talk about property value, right? This here are partial make or breaks, right? And some part will move our numbers around. So property value. If a property, we have a minimum, the property value, not the note value, but the property value minimum has to be $50,000. I have bought $2,000 UPBs on an $80,000 house. I've done it.
Yeah.
$300, fine.
Yeah. Me too. It was great.
Yep.
But the house has to have some value there.
Yep. I go up to 300. Nathan goes up to 200 property value. Now, have I gone above that? Yes. But as a rule of thumb, that's our kind of a target. That's our ideal situation because borrowers in typical spots where they have a $300,000 house plus, they get into a position where they technically can't, though they can afford to not make a payment or two and go hire attorney, file BK, all these kind of factors.
Yep.
If the property's over 100,000, beautiful. We love that deal, right? 50 to 100 is better. Under 50, it's a no-go immediately, right? We made the point that anything from a $50,000 house to $1 million house, your foreclosure fees, everything, servicing fees are always the same. It doesn't matter. That's why a house under 50,000 gets eaten up by cost too damn easy.
Yeah.
Location, it's a make or break. So when we come to population, we are looking for cities with 20,000 or more. We can get down to 15, but this is a kind of rule of thumb. 20,000 or more in a city, or if the county has 100,000.
Yeah.
Right. We're just outside the really big city. We're in a smaller city. We'll deal with that. Right. We just don't want the little rural areas because we can't sell the property. It just makes it harder to do situation. And if you say, Dave, it's performing for a year, that's great. If you can guarantee me payments for the next 30 years and I can get your firstborn child if you default, we can talk. However, I promise you that it will probably default, or if it doesn't, wonderful. But we want to make sure we're covered. And most note buyers go by the same idea.
Yeah. 20,000 people roughly means to me that there's a relatively healthy real estate market. So if I end up taking back that property, there's a good chance that I can resell it. Smaller than that, you get, everybody knows that's the old Johnson house, a town of 5,000 people, and it becomes very difficult to resell the old Johnson house because it's not just a house, it's the old Johnson house, and small town politics gets in the way and it makes it very tough to sell houses.
Something that's not talking about, and we've been inside a lot of the bigger groups for seller finance.
Mm-hmm.
I love to hear in this pool. Has anyone heard about debt license per state? Not originating notes, not RMLO licenses, owning a debt. And most people say, we've heard it. We heard it Friday call. Well, I don't need a debt license. I'm originating the debt. Well, I'm sorry. As soon as you originate the debt, you then become a collector. You may not be collecting debt. Your servicer may be doing it, but in certain states, you as a debt holder need to be licensed.
Yeah.
You have to have a bond, insurance. Now, not every note buyer has this bond. Not everyone has a license. Some states they are, some states are not. However, if you're originating in some of these states, this is especially not New Orleans, but Illinois, Kentucky, Kansas, Georgia, Oregon, Washington, California, PA. There's a bunch of other states that require it. We're just listing a few here. Another big thing, this doesn't make or break for some investors. It does for us. There's certain states we avoid. And the reason we've avoided it is because of long foreclosure states. I forget who mentioned before, they have a PA deal. If they were going to have to buy a Pennsylvania note, I may have to spend 18 months plus in foreclosure. And then if they file bankruptcy, it's even farther. So it makes it more difficult where if we're in Texas, Tennessee, Missouri, New Mexico, wherever, it's a lot easier to deal with in those kind of states. In Kentucky, Connecticut, believe it or not, there is a law that the original lender, Bank of America, has to show up and be in the courtroom if you don't go around and figure out the loophole. However,
as well as everybody else who that note has been assigned to. So I had a note where it had like 7 different companies where this note had changed hands over time. And I went to go and foreclose. And that was what I was told, that a representative from every one of those companies had to be there in person in court. Well, half of those don't even exist anymore. And it was just absolute mess. So there is a workaround. It's not really easy, but it is doable. Thank goodness. So if you're in that situation, I could talk to you some more, but it's messy. And again, we're not looking for messy. We're looking for easy, clean. We just want to collect.
And again, we want to help you sell, for the biggest dollar, right? So if you can avoid properties in these states and whatever, you're going to get more for your money. We'd love to be the person buying your note, but in situations, we want to make sure you're creating these notes and the idea of a note buyer in case you want that exit. Is not being licensed a debt collector defensive note? Yes.
Yeah.
Yeah. Right.
Yeah.
If you're not an originator and you originate debt, that situation. It's a license. Is it a gimme money wise for the state? Absolutely. But they're really just trying to get rid of the mom and pops that are out there. So yes, if you are creating in Georgia and you don't have a license, you're technically now, do everyone get caught? But I don't think you'd want to be in this position to get caught. Let's put it that way, right?
Yeah.
So the next point is this is a make or break for us. For those originating debt, the down payment, we want at least 10%. We want some skin in the game.
Yeah.
3%, 5%, 10% does not work for us. Some people it does, not for us.
We
want
got to see that
actually play.
they're invested, actually invested, like monetarily invested, that where they care about this. Walking away from that much money just would hurt. So we want to be able to see that. That's it's an indication of how willing or how likely they are to continue to make payments.
So seasoning. Our question about seasoning regards to how long or how many payments the borrower has made. Sure, you guys heard of table funding. If that note has no payments made, for us, for me, I'm not really interested in buying it. I know they have the ability to repay. However, I'm not interested in buying. However, Nathan will buy it.
Yeah, I'll buy those brand new if they're like table funded. Absolutely, I'm very interested in that. Jay's got a great question there. Is there a point where additional seasoning doesn't bring additional returns? Correct.
So, yes, right. So if you have a loan that's paying for a year and you get 2 years, it doesn't change anything. It's a risk level. Great question, Jay, right? It's a risk level. For me, as you can see here, 3 months, I increased my yield 2% because of the risk level, right? I get the fact that if something happens to a borrower, they added debt to the borrower doesn't realize that they had some money saved, and then they run out. I just want to make sure they're consistent doing. Nathan's not as strict as I am with that.
Yeah, my thinking is if they've just qualified, they're going to be too excited to miss a payment in those first 3 months. I think they're going to continue to make payments.
So talk about the type of property we are mostly interested in.
Single family residential, by far. Up to 4 units, yes, but single family residential for sure, for sure. Land is just kind of weird. It's hard to value it. It's hard to like. It's not necessarily hard to sell necessarily, but it can take time, and it's just not something I'm interested in doing. Again, if I end up taking back that land, hard for me to value, hard for me to know, how to sell it and who to sell it to. Mobile homes, it's a car on land. So if it's something where it's on, like they have title to the property, that's fine. So if it's like a manufactured home, that's fine because it's a house on land and it all comes together. But if it's just a mobile home, not so much. Residential, yes. That's what we're looking for. Commercial, I'm not necessarily a commercial guy. That's going to be Dave's.
Yeah, I had no problem doing mixed use, right? That kind of thing works well for me. Brian asked for especially tiny homes, RVs. I'm gonna tell you that I'm not interested in them. RVs, I'm not. That's more of a car note, right?
Yeah.
I don't want to play the repo game. I just want to foreclose and get the debt. Okay, we didn't say this at the beginning, and you guys are probably all saying this. We're lazy.
Yeah.
No buyers are lazy. We sit behind the computer, we crunch numbers, and that's what we do. We basically Bank of America. They never leave their desk, right? We want to treat you like Bank of America.
Yeah, just make it super simple and we'll buy them all day long. Creative is fine to a point. If it starts getting too complicated, it's just too messy, and we start to lose interest. Tiny homes, that's an interesting one. I don't know.
I've not seen many of them at all.
I haven't seen any. I'd look at it.
Yeah, Brian, that's a good point. I like it. Thank you very much. I'm developing one now.
Okay.
Well, let's see the interest rate. Let's see where it's stated it's in and see what term you put on it. We're all about how do we, again, it's all about how we foreclose on it, right? If it's on land and we can foreclose like a traditional real estate, I'd probably be into it because of the situation.
Yeah, me too. That'd be interesting.
Yeah, that's awesome, Brian. That's awesome. Yeah, I'll read that in a few minutes, but yeah. So I'll let Nathan read that while I explain the next one. So LTV and CLTV. Loan to value is what the balance of the note is compared to the property value, where CLTV is typically used for seconds, right? That the collective loan to value is what it is. So, $80,000 first one, $20,000 second. Well, that 80,000's loan to value is 80%. But the 20% is a now collective value balance of 100%, even though it's 20,000. So, but we're all focused on the investment to value, ITV. So I can buy 100% of a CLTV as long as that value is up there, right? We're going to buy it up. ITV up 75%. If we're going to buy second, yeah, go ahead.
Brian's question is interesting. So developing 42-acre property in Tennessee for RV/tiny homes. Now, when I read through this description, to me, that sounds like land. So personally, probably not. I would probably pass on that because really what you're selling in there is the land. If it's got a tiny home already on the property that is like hooked up to plumbing and everything else, I'd be interested in something like that. But if it's just a plot of land that somebody put an RV on, that's probably not for me.
Yeah, remember, what's the security? What do we take back if the debt goes bad?
Yeah.
Am I taking back the tiny home or the land? How am I secure? So seconds, Nathan's not big on seconds. We're both not big on it, but we'll look at it if it's the first is performing, and that if the second is performing and the first is performing, and there's equity protection. That means that the first and second versus the value of the property, there's some space in there to protect our second. That's fully covered, we call it. But we need to know if the first is performing, and we need to know the balance of the first, so we can figure out if there's equity. Okay. So the next one is monthly payment. It's a make or break. I'll make it red again. So make or break means that if your monthly payment, say it's a $100,000 balance, your payment's gonna be about $300 a month, right? But if the borrower is paying the servicing fee, we don't care what that payment per month is.
Right.
It could be $100. I don't care.
Yeah.
If we, the lender, now you can put this in your note when you create your note. This makes your note more valuable again, guys, right? If you create your note that the borrower, not the lender, but the borrower pays that servicing fee, and make sure you talk with an attorney how you can structure that note agreement that it's not a flat amount. It needs to fluctuate with the cost of servicing.
Yeah.
That the servicer, that the lender is, if we have to pay it, the lender, we will we'll buy notes that have a monthly payment above $300. If that note's $200, and the reason being is servicing fees range from $20 to $35 a month on performing notes. If we have a $300 note, we're gonna have to pay $30 on that a month, which is 10% of our income gone to servicer. But structured that your borrower pays it, and guess what happens? Your note will sell for more money because note buyers are going to discount that the monthly payment by $20 or $30, whatever the servicer is. Okay.
And again, depending on your borrower, if they can handle, again, I wouldn't put a flat number in there, like Dave said. I would put in some kind of language about that they would pay the servicing fee and just leave it open like that. So if the servicing fee is $15, great. If it's $35, that's fine, but it's covered by the borrower, depending. So maybe you as the note creator are using one servicing company and they charge $20 a month. My servicing company, I'm going to have it transferred over to my servicing company. They charge $30. So I want to make sure that the borrower is going to be able to pay the servicing fee, whatever that amount might be. Typically, it's not much more than that, $35.
Yeah, we'll open this up for Q&A in a few minutes. We're just going through a bunch of stuff right now. Again, if joining us late, please put what state have owner finance notes and how many you've done. Again, we're not working to find you borrowers. We're note buyers. So again, this is one thing I know we put into the thing here is, listen, guys, if you're buying notes, you can service them yourself, but make sure if you're not servicing yourself, you're using a licensed servicer. Please, we run to people. Yes, licensed in the state the property is located in.
Yeah.
We've worked with people who have been, I'm gonna put that question out there, right? Who are using apartments.com as a servicer. That will not work. No, apartments.com. If you're not if you're using partners.com, gotta get rid of them. And it's okay to service yourself. That's fine. But make sure you're doing it legitimately, because a note buyer may have to go and clean up all the old payment histories to see what it looks like.
So say, for example, let's say you've created a note, the first 2 months, they pay exactly what they're supposed to pay. Say the payment's $500 a month. They pay exactly that $500 a month. No problem, no problem. Month number 3, now they're late by 15 days, and that triggers the late fee. And then in your software, did you account for that $15? Did that come out of their next payment? They still made a $500 payment. So then what? How is that $15 being tracked? Let's say they missed another month, but then they made it up the next month. Like all those things, that it's far simpler to have a servicer take care of that for a very low cost. But that's, and again, that's far more valuable. Again, as a note buyer, if I can see a pay history that has come from a third party, not the owner of the loan, I'm not calling anybody a liar, but I'm just saying, if I can see the pay history from a third party, that's more valuable to me than somebody that's been doing it themselves and has the potential to fudge some of the numbers. And again, I'm not pointing fingers. I'm just saying,
because the note buyer is going to say, what's the next due date?
Right.
If you tell me last payment date, has nothing to do with it. It may be the same, but last payment date does not equate to what the payment through date is or whatnot. That can be different. It can be the same. It can be different. It all depends. So we're going to talk about usury law for a second. We're going to tell you to go to your attorney and ask questions if you need to. But each state has a law in place that for owner occupant borrowers, that if it's not an investor, landlord, or whatnot, that it's the maximum you can charge on a note. If you use an RMLO, you're working with this as well. But you can't, there's certain interest rates you can't charge 15% to anybody. If there's a borrower who's living in the property, again, that Dodd-Frank law, you need to make sure you're under the usury law.
Every state's different, so you're going to have to research.
Yep.
Yeah,
absolutely. So just a recap again, notes are not bought on based on percent of UPB or BPO, broker's price opinion. They're bought on IRR or yield most of the time, right? Because when we're buying a deal, we have to presume the fact they may foreclose, which means we may not be buying it based on strictly yield.
Yeah.
In key, make sure the borrower is paying that servicing fee. The higher the interest rate, the more I can pay for the note. The lower the term, the more I can pay for the note. Make sure that property is over 50,000. If there's debt licensed in the state, try to avoid it if you can, because note buyers are not sometimes licensed in that area, which is fine. And here's a quick pool of servicer. It looks like no is a bigger one for note servicing. Interesting.
Ooh, interesting. Okay.
Right.
Highly recommend it.
Yes.
Even
$23 a month.
Yeah.
Charge the borrower. You don't have to worry about it. They send a monthly statement out at the end of the year. They send out the year-end tax statement, all that stuff.
Even if you end up paying it, that $20, $30 a month per loan, it's well worth it. Just the cost of doing business is well worth it.
If you're new to notes and originating notes and whatnot, and you get into where you will, because the last 3 years have been really good for our portfolio. Take a job. Is it when and if it defaults and you need to show a pay history and you have it on an Excel spreadsheet or something, it just won't be as nice. The judges may have a problem with it. The borrowing, we don't want to give the borrower any ammunition down there. Okay. Another one we didn't talk about, Nathan's big stickler. Please make sure your note and agreements are more than 1 page long. Just 1 page quick. You can't draft a lease agreement that 1 page long. It has to have substance in it.
Yeah.
Right. No napkin deals. Okay.
Brian was asking if we had a specific servicer.
There's a bunch.
There's a bunch. It's hard to just pick one, honestly. You're in Tennessee and North Carolina. That's the other thing is, again, not all servicers are licensed in every state. So you're going to want to research that. If you're always doing deals in Texas, you can find a servicer that just does Texas. Oh, there we go.
Yeah, I have a chart
Dave's
on
got a
my
chart.
diligence portal that this is a real estate due diligence portal, but here's states and what servicers. We've used FCI, HomeKey. Land Home, Madison sends on here as well. We don't recommend or tell you anything. That's fine. Allied, for those, I see a comment about Allied. Allied is not covered in every state. I know what may be said, and what's shared.
They're kind of
I
doing a
won't-
bit of a workaround that's
Yep. We won't say
okay.
too much about it, but yeah, they're only licensed. You can look what states are licensed through the system. But yes, so yes, you can go to my portal if you want to, or you can go to their websites. I just kind of collect it all together. Davey, thank you for mentioning that. We want to make sure that our investment to value is 75% maximum and be creative, 80-20, 75-25 to get to a point where you make a note that's sellable for no buyers to buy, right? We can buy partials, all this kind of stuff come to play. When partials come out, that ITV kind of goes out the window. Nathan won't buy as many partials as I will, but it's out there.
Yeah.
We're going to target 14%. So put that in your calculator just to give it gamut. So you expect a discount, right? The discount's based on the interest rate in your term. Your population, right? We want to make sure we hit 15, 20,000 people plus in the city or county of 100,000. If that lender is paying servicing fee and you didn't make the borrower, make sure that payment's above 300. And I don't think we mentioned this. I apologize. Okay. If you guys are creating sub twos, I love to know if you are creating sub twos, which means that you created a note, you wrapped a first debt, you took a borrower, you moved them out of their house. You then took it, put it in a trust or however you function, and then sold it to a new borrower. And you want to sell that wrap note. I'd love to know how many people here have done that. If you created you done a wrap note with underlying debt. I'm gonna put that in the chat quick. Put that real quick in here. I was really curious how many people have done it. Yes.
Again, nothing wrong with that at all.
Nope.
At all. Okay.
So,
good.
so if you are creating that and launch that bad boy. All right. If you're creating a note with underlying debt and that borrower has been moved out and you are not the underlying borrower, you didn't have a hard money loan and you didn't wrap that, because there's two different wraps. There's a subject to where you're subject to someone else's debt, or you are underlying borrower and then you wrap that. Two different scenarios. If someone didn't understand that, please let me know. I can re-explain it. If you have what I'm calling a third-party borrower that you paid off to move out and you wrap that, we will not buy that note unless we're paying off the underlying debt. I know you're probably going to put in the chat before you can stop typing, but Dave, do you realize that 3% debt, 2% debt, you're going to pay off? Yes.
Yep. Totally realize that, but yeah. Included in my purchase price or Dave's purchase price, that has to include paying off that underlying first. Just it gets way too messy, way too fast. If somebody defaults on any one of those parties defaults, it gets really messy really fast. And so
and I know people have great
we're
systems
lazy.
out there that protect all that. I ain't doing it. It's something that we've seen. We've seen some problems with those existing borrowers who are now coming back and fighting. It's all doing sales. Yes, absolutely does. But some of the borrowers are coming back and contesting the fact that original debt that they agreed to, they didn't understand terms. I don't want any of that headaches of that person. I don't know who it is that you had a relationship with that now I'm taking on. It just gets too messy. And what you don't realize, if you have never done a foreclosure, is judges are more lazy than we are, right? They don't want to learn anything. They're the smartest person in the room. You're not teaching them.
Yeah.
Right. I don't want a problem when I'm foreclosing. The judge says, what happened here? And doesn't understand it. I'm not playing the game. Someone else may. We're just not going to. So if we have a third party borrower, we're paying off the debt. If you don't, and you are the underlying debt holder, first lien debt holder, then we will buy it and not have to pay off the first lien.
Sure.
Because we're dealing with you already.
Yeah.
We're okay with that.
Yeah.
Yes. I'm glad we covered that. So key here, find deals where you can create equity. You have $100,000 situation, and then you create $150,000. We're going to pay you 75%, and you may walk away with 25 grand in your pocket. It works, right?
Mm-hmm.
This is a key one that came up in one of our private conversations. For those who are creating Texas only, wrap notes. The borrower cannot pay servicing fee if the interest rate is over 10%. I'm going to probably guarantee nobody in this room knew about this law. Servicer just found out about it. Any second lien wrap notes, the borrower, if the interest rate over 10%. Justin, I don't know. It is part of the law in Texas.
Law?
Yeah. Yes, Jay. Texas, maybe come in California. They're far, but yes, right. We understand Texas is one of the best states in the world for foreclosing on it. For people who wonder why, you can foreclose by lethal injection in Texas, which is usually about 68 days. It's not the fastest in the country. Actually, Missouri is, but in the same gamut, it is the easiest to work with.
So if you're doing your wrap at 10%, no problem. Or if you're doing it at 11%, it just means that you can't have the borrower pay for servicing.
Yes. Some people say, well, just change the interest rate, make it a little bit higher. It doesn't always equate, right? It depends situation. So yeah, as we can see, we have more people doing that there's underlying debt, doing wrap notes. If you're doing strictly a seller finance where there's no underlying debt, all we said before out the window. But if you're wrapping debt, I know a lot of people talk about it, and I'm not saying the Knicks and the Marks and the, are all wrong. I'm saying is no buyers like us won't buy it and won't play with it at all, right? So
just
again,
keep that in mind, and we can look at the chart. We'll go over some of the numbers and show you kind of how and why that works.
I'm sure a lot of you guys who have been doing notes for a while, or those who are new, are going, holy God, I just learned a lot. I'm glad. And I'm hopefully that you guys will really kind of grasp everything we're saying. Again, we're note buyers. We're not note creators. We've done that, but primary business here is to teach you guys how to be the best note creators. That if you need to sell the note, go for it. But don't create 5%, 60-year term notes with a borrower who occupies a house with no underwriting. Don't do it. Don't do it. Don't do it. Okay. So what can change prices? Armalo, if you didn't underwrite right, security type. That's a big one. Your note numbers. That is the biggest factor changing prices, right?
Definitely.
Because one interest rate to another will dramatically change the price of what I'm going to pay for it. A 5-year term versus a 30-year term dramatically changes the price. Again, also changes the monthly payment, right? The higher monthly payment, the more I can pay for it because I'm going on returns. Seasoning for me, not as much for Nathan. So create 80/20s. Make or break the monthly payment, that $300 a month. The wrap, again, we will not buy it unless we can pay off the underlying debt at all. That's no for us. Our land, mobile homes, no good. Residential, absolutely. Commercial, small commercial. I'll do mixed use. I will not be doing hotels, motels, and malls, all that crazy stuff. Just because I hate shopping. So down payment, we want to make CDC 10% and CLTV, LTV. This does not change our pricing, and it helps with you guys because you can get a little less discount. So I'm going to open up for questions. If you have a particular question that you could not put in the chat, we're going to move to the calculator portion here. We're not going to try keeping everyone too late, but I want him to get the calculator. If you have a particular question and need to be unmuted, let me know. I don't know if you can raise hands at all, but yes, I think so. Nathan, can you raise your hand on that? I don't know if you can or not. If not, I just want to make sure people can raise their hand. Are you able to raise hands? If you can find it. Well, if you need me to unmute you, let me know and I can unmute you as we go through here. We're going to move to a calculator version. Sam, thank you so much. Making sure people can, if you have to raise your hand. Yes, it worked. All right. So it's in the participant screen and then I can lower your hand.
So who's got a deal We can walk through some of the numbers here and we can show you
Yes.
how that would work. Jay's got a deal.
All right. All right, Jay, you're unmuted. Your
Yeah, it looks like
camera's
we've got
off.
audio.
That's okay. Go ahead, Jay. Oh, John, if you have a particular deal, we can walk through it. We lost Jay for a minute. I'm not sure if you're unmuted, Jay, but I think you're maybe muted on your side. I don't know, but so John, we're going to be sharing this spreadsheet eventually. We want to show you what it means. If you're looking for more particular things, we'll definitely do it. Hassan, I will send out the link to this unlisted kind of thing. Jay, you can talk, but Hassan, we'll be hopefully sharing with everyone. But I would stick around if you can, because the calculator may show you a little bit understanding. Understand, no problem, man. Shoot us an email, and we'll go from there. And we'll catch you soon. Go ahead, Jay. What kind of deal you got going on? Let's put some numbers in this bad boy.
Okay, so it is it's a note that was originated in April of this past year. It is a manufactured home on a permanent foundation, detitled in South Carolina.
Okay.
Okay,
What city?
just south of Greenville.
Okay.
Okay.
Yep.
So far, so good.
Yeah. So property value. I mean, stuff there like this, it's selling for anywhere from 225 to 250.
Okay.
We sold this one. The sale price was $250,000.
Okay, that's good.
We're gonna presume that the population is big enough.
Yeah, that GSP area. I don't know what it is, but it's probably
Yeah, it's fine.
north of them. Yeah.
So you're gonna sell the property for what dollar amount?
I sold it for 250,000.
Okay. How much you get down?
Well, 30,000 down.
Okay.
Owner occupied. Yep.
Is it borrow occupied?
Yes.
Okay. Did you do Armalo?
Yes. Ability to repay was done by Call the Underwriter.
No, Max. Cool. Is it a wrap note?
It is a wrap with my private lenders, and that would be, obviously paid off moving this second into first position.
Yeah.
No
So
problem.
lender
Yep, that's fine.
borrower, that's fine, right? In that case, we don't have to pay it off, but we like paying it off. We don't if we can, right? So this
Hey,
number doesn't come
Dave,
to
go
play
back
here.
up to property type. You got land in there.
Oh, let's put this back to residential.
Yeah.
Right. We're good there. So what kind of securities type is this?
Say that again. What kind
What kind
of
of security? Is it mortgage? Do you trust land contract?
South Carolina is a mortgage state. Yeah, mortgage.
Okay.
Okay.
Yep,
And then
that
it's
lien will
second.
be moved first. Well, it's
Okay.
first, right? It's currently first, but at the time of either sale or hypothecation, the private money first would get paid off.
Okay, we'll put it first for now. But is it interest only or no?
No, it's fully amortized.
Perfect. Who pays servicing fees?
Borrower.
Nice.
Love it. And you said, well, let's put it for April 1st, 2023.
Yep.
Uh,
The original balance is so I created two notes. So that balance there is $180,000 on the mortgage that we're talking about, and I'm going to keep the other one.
I love it. What is the term on it?
360, interest rate was 9%.
Okay. So, and then we're gonna say next due date will be next month or so. It doesn't really matter,
Yep.
right? So then current balance of note.
I mean, it's probably pretty close to 179,000 and
Yeah,
a
we'll
couple
just do
hundred.
Yeah, roughly.
I had any other sheet somewhere down here. Yeah, close enough.
Okay.
Right. So we don't
Change
have-
the year there, 2024,
oh,
just so we don't get an error message there. Yeah.
so and then presuming I look at table funding, which is fine. So what on this idea, we're around $126,000 purchase price. And what really kind of makes that happen is truly the fact that the 9% here,
Mhm.
right? We're at the fact that this $180,000 note, you're saying, but Dave, the 180 grand. Yes. But if we put in the so on our yield factor, we have it this here. I'll put this over here, yield and ITB. So on the yield factor, we're 14. As you can see on that chart, because you're at 9%, and we're targeting 14 for that case, we're already down here at 67%. Right? Which kills it, which really kind of hurts.
What would it, so is that just your minimum threshold? Is that 14%?
It's not everything, but a lot of people will do that.
And given the parameters there, you've got a little bit of seasoning. South Carolina is a decent state.
Yep, South
All the
Carolina.
rest, 13 might be doable.
Yeah. So remember the fact that we have our capital, cost of capital, and I'm
Yeah.
going to tell you the cost of capital is going to be higher than it used to be,
Yeah.
right? So if our capital stays at 8-9%, we can't go get 11. We need some marketing room, right? So we have some kind of flexibility. What happens?
Yeah. No, I understand. Yeah.
Yeah. So
Arbitrage is the eighth wonder of the world. Screw compound interest.
yes,
Yeah.
yeah, you're right. Yeah, absolutely. Because when we talk about compounding interest, I can make infinity on infinity, which is ridiculous. So yeah, so we're looking at 70% of UPB as a guide, right? When we talk about this stuff, which is key. So with that 9%, now let me just show you for those who are watching. Watch what happens if I made this thing 240 months. Look at the payment. That number went up. Simply
Yeah,
because
by
of term.
Yeah.
Right? If I change this to, let's say you were at 12%. Look at the number I can pay. Went up.
Yeah. See, when I'm doing this, I'm basing my note numbers on local market rents. And putting people into juxtaposition of paying 1,800 a month or 1,800
Yeah,
a month.
absolutely.
Yeah.
And we're not saying you have to sell note buyers. You're just taking one of the exits that you have available to you out of the picture. Now, could you sell a partial? Absolutely. But I'm going to tell you, partial for note buyers is based on yield as well.
Yeah.
Right. It comes back to it. If you can guarantee me payments on a situation, I may be in the 12 number, maybe 13. Right. It all depends on what your scenario is and what my cost capital at that moment is.
And when you say a guarantee, is that for a period of time, like for 2 years?
No, well, we structure our partials that if it defaults 5 years from now, right, and we're in a 10-year partial. For those not sure what partial is, if you have 360 months of payments and I want to buy 5 years, 60 months, I'm going to collect that monthly payment of $14.48 a month for the next 5 years. If it defaults in year 2, what I call basically is you'll pay me off the balance of the debt of that moment. So if there's a situation where we are in a spot where that borrower defaults and then 9 days behind, you come around and say, I'm going to pay off the balance of your balance, not the borrower's balance, but the balance of that partial off.
Gotcha.
So the other thing to remember, Jay, is, and you don't have to say, but whatever your underlying loan amount is, you've already collected $30,000 plus you've collected payments now for what is that, 7-8 months now?
Yeah.
So that all goes. So I would pay you, according to this, about 126,000 plus the 30. You're up to 156 plus whatever payments you've collected. You're up to roughly $160,000.
Yeah, I mean we were all into this one for about $89,000. So
That's a nice payday.
Yeah, it's a really good deal.
Yeah.
Okay.
A little bit of money right there.
Yeah. And if you can continue to get those kind of properties and do these kind of deals, absolutely.
Yeah.
Absolutely.
We'd ask you how many you can do, right? How many can you do would be the question. If you say I can do 50 a year, I can do it. We can do as much you want.
Yeah. Those are really nice looking numbers. That looks really good. Good work.
Yeah, I mean, this was a home run deal. I would say that my my average deal in that area is probably about 75% as good as that one.
Okay.
Okay. That's
Still
okay.
decent payday still.
Yeah.
75% of
And
that.
we could do another one if you want a minute. We want to give Damien a shot here to, you know, go ahead, Damien, I'm gonna unmute you. Go ahead and
Hey.
give me your situation.
Sure. What's going on, guys? Thanks for having
Hey.
me. So yeah, so the question I was asking before, I think you wanted me to talk it out.
Oh yeah, yeah.
So another way to explain this, right? So basically, what I was saying was, say if you want to wrap something with unfavorable terms, can you wrap that at better terms? And then where are you buying it only, and you're not looking at the underneath, but you'll know that the underneath, the underlying note gets paid. And I think you sort of answered that with the sub two that you would do that. But here is another sample. Say somebody wants to, a seller financer, right? Only wants to sell a finance at interest only payments, right? So I buy the property and the seller finances it to me with interest only payments, but then I want to go and find a penalty box buyer. And then I use, then I wrap it, do the RMLO on there, but you have the underlying is interest only payments, right? But when you do the wrap, it's amortized at 10% over 30
Yep.
years, right? So, okay, would you guys buy something like that and only look at what the wrap terms are?
Because you're the underlying borrower, we're not caring about the original debt, right? We're in a spot where we're not is caring about because you're the borrower of the underlying debt.
Okay,
If you push someone out, not push them out, if you paid someone to go somewhere else and take over their debt, we don't want to mess with that. But because you're the borrower on the underlying debt, we have no problem with it because then we're dealing with you directly.
Yeah.
okay,
That makes sense.
got it.
Yeah.
I actually have another question, if you don't mind, too. So, so I was saying that I do transaction coordination business, and now I'm going to get into the weeds with this. I'm way too much into the weeds with this transaction, as I usually do, right? So we usually, being creative transaction coordinators, we usually help people along more than what a regular transaction coordinator will do. So, this guy is going for a DSCR loan, right? But he needed gap funding, right? So one of the things I came up with was, so he was offering 3 other properties, right, as cross collateral. So one of the things I was saying was, have an idea of have a private money come in and wrap one of those properties and then sell the note right away so they can get their capital right back out. So, it would only be like, I don't know, like 3 or 4 weeks or something, right? So one of my questions is, right, so obviously, you said you wanted like down payment of I think 10%, right?
Yep.
This is attached to another loan, right? Or a whole other transaction. And this is just the gap funding piece of that, right? But it's a separate property, and you're going to get like the logical first position that you would do with a wrap. Now, would you want to look at the HUD on the primary transaction to see that he actually put a down payment in? Because you wouldn't see that on the subject property.
So
Yeah,
the
he
down payment has to do with the current borrower. So if you're doing a wrap, it would be whoever the new occupant I'd be looking at that down payment.
The end borrower.
Yeah.
Oh, so no, this guy is actually going to keep his house, but instead of doing like what gap funders do, right? They'll put a second position loan on. So what I said, why not, instead of putting a second position loan, why not wrap this property that he's offering cross collateral? He's going to remain the owner of it, but then the private money lender will have a wrap note on there instead of a second position note, and this way, in this way he can make it saleable. So somebody like you can buy it, so he can take his money out quicker, like in 3 weeks or so.
I think I have to think about it a little more. I'm getting a little confused what the pieces are.
Cross
But if-
collateralized with a second property.
Yeah, so yeah, maybe this isn't for for this Zoom. Maybe I can grab consulting
Yeah.
time with you guys on it. And bring in this other guy I'm working with on it. But
Yeah.
yeah, so basically he's buying one property and we're saying like, hey, the CLTV is gonna be like 110 for a gap lender. Can you offer cross collateral? So he offered like 3 other properties, right? And what I was saying is instead of doing that one note with multiple properties on there, just go to one property and do a wrap note on one of them and then sell that wrap note to a note investor right away. So you see that property that's offered as cross collateral isn't part of the purchase, but it's the same borrower that is gonna ultimately own both. So that the 10%, his down payment is gonna go to the property he's buying. I know, I'm sorry that this is kind of complex.
Yeah, let's circle back. Shoot us an email about it. I'll be emailing everyone with the link to the. I'll probably have a private YouTube thing for everyone, but yeah, maybe we'll jump on a call soon to figure it out. We just want to basically buy the note, make sure the security of that debt. I think we have to follow who is the borrower. We'll see if we can connect with your guy who's doing it.
And if
Okay.
there, but my issue with it, and if I'm understanding correctly, is if there are 2 properties securing one note, that's getting messy. Even
Yeah.
if it's short term, maybe.
It comes back to what is the CLTV on it? What's all the debts
Yeah.
on it? Is it
Yeah.
second position or one? Kind of thing. We'd have to see how it's structured on both properties.
Yeah, and maybe if I sort of like whiteboard it out.
Yeah, maybe.
Trying-
Yeah.
I think it'll be easier to
Drawing.
explain, I think.
Yeah.
Cool. Awesome.
Interesting.
Thank you,
All
Damien.
right, thank
I
you.
love interesting things. Okay, so if anyone has any other deals, I'd love to kind of unmute you guys, raise your hand. As you can see what this comes down to, we are looking to maybe build something similar to this whole spreadsheet out there for you guys to work at and make it a little bit cleaner, easier to work with. But this is really kind of an idea of what it means for note buyers, what it goes into. And as you can see, there's people here that are really seasoned who are going, oh my God, I'm learning something. It's crucial to understand how the note buyer thinks of stuff, right?
Yeah.
The servicer, the costs, the expenses, who the underlying borrower is, what type of property it is. Then it goes back to people say, listen, I have a note and the borrower can only afford $500 a month.
Yeah.
It may not be the borrower for you, or keep it. That absolutely. So this is just the equation. If you're a spreadsheet person, this takes the variables tab over here. It puts 14% in for our variables, and then it takes the term 41 down here, all that stuff. And then the term remaining, as well as the net payment amount. And add C16 if there's an underlying debt. Then this does the percentage of the percentage of property value is 75%. We have a variables tab. Like Jay's like me, spreadsheet person, right? So yeah, I'm a spreadsheet crazy person. If you don't know me yet.
I do the same kind of thing. I typically just do it on my calculator, but
Yep.
if it's
So
a
this
little
is-
bit more complicated deal, then I'll go to Dave and say, hey, how do we do this?
Yeah. Yeah. If you guys start building calculators for your business and you need help, I have consulting that I can do that for you guys. I've built probably 5 or 6 people's calculator in the seller finance space because I understand spreadsheets, I understand numbers, and I can create them pretty quickly. So absolutely. Dean, you're welcome. Your engine buying notes.
Good.
This is the idea of buying notes, I guess.
Mhm.
This is not as crazy as my and Nathan's internal calculator. This is kind of a guide for you guys.
Mhm.
So yeah, you can definitely send the note to either one of us. We're 2 different companies. If you didn't catch it before, we're 2 different investors that work together. We want to buy notes. We want to buy as much as we can. So we want to make sure that you guys get this. There has to be more questions. If you have a question you feel it's dumb, you want to send it privately to Nathan or I, please do that. We'll probably go for another 5 or 6 minutes if things get quiet. If not, I'll go a little bit longer, but I want to make sure that we answer all the questions coming. A debt license question. We'll do our best to answer them. I
We'll do our
can't
best.
promise we can answer it. Because debt license is not a yes or no question. It's truly depends how the business is structured. We had a webinar on that. I'll see if I can find it while we talk right now. But
And Ebony, if I remember correctly, you're Georgia.
yes. Ebony, you're in Georgia, correct?
Let's get her. Can I unmute her? No.
I'll make you go so you can.
Okay. Let's try this again. There she is.
Hello. Okay. Hi,
Hello.
guys. Just wanted to ask that question because I am here in Georgia. When a person is required to have a debt license, does that include the person who originates the loan as well as the servicer, not servicer, I'm sorry, as well as the note buyer? Do they also have to have the debt state, the
Good
license for
question.
that state?
Yes to all. Yeah.
Okay.
So the originator has to have one because you created debt
Okay.
that now you're collecting on. And then whoever buys that note, yes, they would have to have a debt collector's license.
Oh, that's information I didn't know.
Yeah. Yeah.
Okay,
So
gotcha.
me personally and Dave, same. I actually don't buy anything in Georgia just because
Okay.
I don't have a license and I mostly don't want to show up on somebody's radar
Gotcha.
and have to register. So I don't do Georgia, unfortunately.
And it's so ironic that you guys are saying this. And I actually took a course, well, not a course, but I guess like a workshop or whatever. And they never mentioned this. And we were talking about creating notes.
I
And
know.
this is my first time I've ever heard of that before.
Yeah.
So it's funny, we've been a lot of the bigger players, and it seems to me they skip over this topic of debt licenses. And I don't know if it's that they don't realize it, don't think about it, but absolutely debt license is a state by state law. Texas, you don't need one, right? Florida, you don't need one. But in certain states, it's required to have,
Okay.
right?
I saw somebody
Illinois,
else's Washington. Washington's another.
yep.
And from what I hear, I haven't experienced it myself, but Georgia and Washington are particularly sticky, where they will hunt you down.
Gotcha. Well, thank you. That answered my question.
Sure.
Yeah.
Tennessee, right next door. Tennessee does not require a license.
Yeah.
Florida, no license.
Yeah. So I did put the link in the chat for the YouTube video that we did probably 2 years ago. And
A while ago, wasn't it?
yeah, so I put the link in there. We did it 2 years ago.
Wow.
Yeah. So if you want to watch it, it's one of our earlier videos. We look a lot younger in the video, but yeah, feel free to take a look at that. So yeah, let me see if I can, it looks like this, but it's just a great video to watch. It's a little confusing. They don't answer a detailed question, but it all depends. So just feel free to take a look at that.
And they're
So-
available to reach out to directly if you'd like.
Yes, absolutely. They're a fee-based service, but you can definitely do that.
Yeah.
So with that, anyone have any other questions or deals we can run through, curiosities, or whatnot, and feel free to email us if you want to copy this spreadsheet thingy. It's not a golden parachute, but it gives you an idea. But just shoot me or Nathan an email. I'll put my email in here, Nathan, if you can put yours
Yeah, sure.
in the chat for those who are going to do it. Oh. Let's see, any other? All right.
I think that's it for
So-
tonight.
I think that's it, guys. No other questions. I am shocked. I am sure everyone learned a ton and are very confused. That's okay. We want to make sure that you are interested. I don't think, Nathan, you actually have a site for a list. Do you have a website they want to sell a note, or just your email?
Just my email.
Okay.
I should put
I
that
put
on
a
the website.
website. That's my
Just-
website for, if you want, actually, it's probably better to.
I'm just rebuilding my website right now. Maybe that's something I'll add. I'll add a tab for
Yep.
capturing data. We'll do it.
Yep. So that's my site. If you want to fill it out for the note stuff, we put this in here. I think we put this in here as well, but I will put this in the chat as well for those who want to grab it before they leave. I hope that everyone kind of learned everything. If you have anything else that you have for us, please feel free to let us know. If you want any special one-on-one conversation about that, we'll have that. If it's in detail, we have some consulting thing we can charge for it if we want to build anything out. But if it's a simple question, shoot us an email or let us know. But it was a pleasure.
Yeah.
Hopefully, you have no other questions. If you do, let us know.
Yeah. Please feel free to reach out. Happy to chat.
Yes. Awesome, guys. Thank you very much, everyone. Have a great night. Feel free to tune in. We'll be on 2 weeks on the 9th for a live 2024 first episode. And make sure you get over to the DME.
Yes, absolutely. Come to the conference. You'll meet people.
Yep. Take care, everyone. Have a great evening. Thank
All
you
right,
much.
thank you.